Okay, so imagine this. You're selling your home,
Right.
maybe getting ready for that next chapter.
Mm-hmm.
And then boom, you find out you could keep a huge chunk of the profit tax-free.
Really?
Yeah. Today, we are going to dive deep into this article from the Squall Financial Group.
Mm.
It's all about how to legally avoid paying taxes when you sell your house.
I love it.
You know,
Legally avoiding taxes.
yeah, it's like that old saying, right? Nothing is certain but death and taxes.
Ugh.
Well, get ready because we're going to learn about a potential loophole.
Oh, I love loopholes. Let's do it.
All right, so
Loopholes are great.
let's start with the basics. What are capital gains and how do they apply to our homes?
Yeah, so capital gains are basically the profit you make when you sell something that has increased in value since you bought it.
Okay.
So for example, let's say you bought a vintage video game console years ago for like $50. Now it's a collector's item. Maybe it's worth $500.
Okay.
If you sell it, that $450 profit is a capital gain. Now your home, that's an asset just like that game console.
Mm-hmm.
If you sell it for more than you paid for it, you've got yourself a capital gain.
Right.
And usually the IRS, well, they want a piece of that.
Okay. Makes sense. So how did this whole avoiding taxes on your house thing come about?
So before 1997, it was a lot tougher to avoid paying taxes when you sold your house.
Okay.
But then Congress passed this thing called the Taxpayer Relief Act of 1997.
Okay.
And it kind of changed the game. This act introduced a capital gains exclusion, but just for homeowners, meaning you could potentially sell your home and keep a good chunk of the profit completely tax-free.
Now we're talking. Tell me more about this magical exclusion.
The exclusion amounts are actually, they're pretty generous.
Okay.
If you're single, you can potentially exclude up to $250,000 of your profit from capital gains taxes. But if you're married and filing jointly, that amount doubles
Yeah.
to a whopping $500,000
Wow. $500,000 tax-free.
tax-free.
That's life-changing money for some people. But I'm guessing there are some rules, some fine print. It can't be that simple for everyone, right?
Right, you're right.
Okay.
There are some specific requirements you need to meet to qualify for this exclusion.
Got it.
Kind of think of it as a two-part test.
Okay. I'm ready for the challenge. What's the first part of the test?
So the first part is what we call the ownership test. You need to have owned the home for at least 2 years out of the 5 years leading up to the sale.
2 out of 5. Got it. Does it have to be 2 years straight, or can it be broken up?
That's the interesting part. The 2 years don't have to be consecutive. So let's say, you lived in the home for a year,
Mm-hmm.
rented it out for a couple years,
Yeah.
then moved back in for another year before selling.
Yeah.
You'd still meet the ownership requirement.
Okay.
And here's another tip. If you're married and filing jointly, only one spouse needs to meet this ownership requirement.
Ooh, that's a good one.
It is a good one.
Now, what about the second part of the test?
All right, so the second part is the residency test. You need to have lived in the house as your main home for at least 2 years during that same 5-year period.
Okay, so similar time frame as the ownership test, but
Yeah.
this one is about actually living in the house,
Right,
not just owning it on paper.
exactly.
What if I'm married? Do both spouses need to meet this residency rule?
That's a great question. So for married couples filing jointly, both spouses actually have to meet the residency requirement individually to get the full $500,000 exclusion.
So let me get this straight. If only one spouse meets that residency rule, we don't get the full exclusion.
You still qualify for the $250,000 exclusion for single filers.
Okay.
So it's not the full amount, but it's still a significant tax break.
Got it. So there's definitely some strategy involved here.
Yeah.
Especially for couples. Knowing these rules ahead of time could really influence when you decide to buy or sell a house.
Absolutely. Planning is key. But timing is important too. What happens if you don't meet those 2-year requirements for ownership and residency?
Yeah.
We've talked about the green zone where you potentially get the full exclusion, but what about those other scenarios?
All right, let's unpack those scenarios.
Yeah.
What are we looking at if things don't perfectly line up with those 2-year markers?
So let's talk about what happens if you haven't lived in your home for the full 2 years before selling. It's important to understand the different tax scenarios and, like you mentioned, we're calling those the zones.
Yeah, zones.
Yeah.
So let's say I sell my home before hitting that 2-year mark.
Yeah.
What zone am I in and what kind of tax hit am I looking at?
Okay, so if you sell your home less than a year after buying it, you're in what we call the red zone.
Red zone.
In this zone, Any profit you make on the sale is considered a short-term capital gain.
And short-term capital gains are bad because...
Yeah, they're taxed at your regular income tax rate, which is usually higher than the rate for long-term capital gains.
Oh,
Yeah, it could mean a much bigger chunk of your profit is going to taxes.
ouch. Okay, so red zone, definitely something to avoid if possible. What about the next zone?
Right, so that's the yellow zone, where you've owned and lived in the home for more than 1 year, but less than 2.
Okay.
Here you're dealing with long-term capital gains, which are typically taxed at lower rates than short-term gains.
Okay, so that's better than the red zone, but still not as good as the green zone where you could get that, sweet tax-free exclusion. So basically, the longer you can hold on to your house and live in it as your main home, the better off you'll be from a tax perspective.
Exactly. Knowing these zones and how they work can really help you make strategic decisions about your homeownership timeline.
Speaking of strategy, we talked about those basic ownership and residency rules, but I have a feeling there's some other factors that could affect how much tax you pay. The article mentioned something called the net investment income tax, the NIT.
You're right, the NIT is something to be aware of,
Okay.
although it doesn't apply to everyone. It's a 3.8% surtax that might be added on top of your capital gains taxes,
Oh, okay.
but only if your income exceeds certain thresholds.
So who exactly needs to worry about this NIT?
So the income thresholds are different depending on your filing status. Single, married filing jointly, etc. But generally, if your modified adjusted gross income is above $200,000 for single filers or $250,000 for married couples filing jointly, then you might have to pay the NIT.
Okay.
But if your income is below those levels, you can breathe easy.
Okay. That makes it a little clearer. So it's basically an extra tax for higher earners. Anything else we should know about it?
Well, the good news is the NIT only applies to the portion of your capital gains that exceeds those income thresholds.
Okay.
So, for example, if you're a single filer with an income of $220,000 and you make a $300,000 profit on your home sale, the NIT would only apply to the $20,000 that exceeds the $200,000 threshold.
Okay, I see. So even if you are subject to the NIT, it doesn't necessarily mean you're going to get slammed with a huge tax bill.
Exactly, but it's definitely something to keep in mind as you're planning your finances.
Yeah.
And it highlights the importance of working with a financial advisor who can crunch those numbers for you and help you minimize your tax liability.
Good point. They can help you navigate those complexities and make sure you're taking advantage of all the tax breaks available to you.
Absolutely. Now, shifting gears a little, let's talk about home improvements. Remember we said your home is an asset, and just like any asset, you can make improvements to it.
Uh-huh.
Those improvements can actually play a role in how much tax you pay when you sell.
Ooh, that sounds interesting. I love a good home improvement project.
Yeah.
So how do those renovations factor into the equation?
Well, when you sell your home, you're taxed on the profit, right?
Okay.
The difference between the selling price and your original purchase price. But if you've made significant improvements to your home, you can often add those improvement costs to your original purchase price, effectively lowering your profit.
Ah, so it was like you're getting a tax credit for those investments you put into your house. That makes sense. What kind of improvements qualify?
It has to be something that adds substantial value to your home or extends its useful life.
Okay.
Think of things like adding a new bedroom, remodeling the kitchen or bathroom, replacing the roof, upgrading your HVAC system.
Okay, so we're not talking about a fresh coat of paint or new landscaping. It has to be a major renovation project that significantly increases the value of the property.
Exactly. And this is another area where good record keeping is crucial.
Uh-huh.
Hold on to those receipts, invoices, contracts. They're proof of the money you spent on those improvements and can be invaluable when it comes time to sell.
So we've covered the basics of capital gains, the ownership and residency tests, the NIT, and even how home improvements can impact your tax liability. Feeling pretty good about this. But is there anything else we need to consider before wrapping up our deep dive? We've covered a ton of ground today. It's amazing how much depth there is to this topic. From the basic concept of capital gains to those specific ownership and residency requirements, and even the nuances of the NIT and home improvement deductions. It's been a wild ride.
And we're not done yet.
Oh, no.
We've been focused on federal taxes.
Right.
Now remember, each state has its own set of rules when it comes to capital gains taxes on real estate.
Oh, right. State taxes. I almost forgot about those. So it's not a one-size-fits-all
Right.
situation. Do the state rules usually mirror the federal exclusion? Or could we be looking at a whole different ballgame?
Unfortunately, it's not that simple. Some states have a similar exclusion to the federal one,
Okay.
while others might have completely different requirements.
Okay.
Or no exclusion at all.
Wow, so this is where things could get really tricky. It sounds like you need a PhD in tax law to figure all of this out.
It definitely highlights the importance of seeking professional advice from a qualified financial advisor,
Yeah.
especially one who's familiar with the specific tax laws in your state. They can help you navigate those complexities and make sure you're not hit with any unexpected tax bills.
It's amazing how this one article about avoiding taxes on your home has opened up a whole world of financial planning considerations.
Right.
It's like a domino effect.
Yeah.
You start with one piece of information, and it leads you to a deeper understanding of the interconnectedness of all these different financial aspects.
It really shows how important it is to be proactive and informed when it comes to your finances.
Yes.
It's not just about reacting to situations as they arise, it's about planning ahead, considering all the angles, and making strategic decisions that align with your long-term goals.
And for anyone listening who might be thinking about selling their home in the near future, what's the most important takeaway you hope they'll remember from this deep dive?
I'd say don't underestimate the power of knowledge.
Yeah.
The tax code can seem daunting and complex, but it's not impossible to understand. Take the time to learn the rules, understand the potential tax implications, and seek guidance from qualified professionals when needed. A little bit of effort up front can potentially save you a lot of money and stress down the road.
Absolutely. Knowledge is power, especially when it comes to your finances. So to recap, we've learned about this incredible capital gains exclusion that could potentially allow you to keep a big chunk of your home sale profits tax-free. We explored the ownership and residency requirements, dove into the nuances of the NIIT, and even discovered how those home improvement projects could actually lower your tax burden. It's been an incredibly informative journey.
It has, and I hope our listeners are feeling empowered to take control of their financial futures. Whether you're a seasoned homeowner or just starting out, understanding these concepts can make a huge difference in your overall financial well-being.
So true. As we wrap up, I'd love to leave our listeners with a final thought. We've focused a lot on the financial aspects of selling a home, maximizing profits, minimizing taxes, and all that good stuff. But at the end of the day, your home is more than just an asset.
Right.
It's a place filled with memories, experiences, and a sense of belonging.
That's such an important point. It's about finding that balance between the financial and emotional aspects of home ownership. Sometimes the right decision might not be the one that maximizes your financial gain, but the one that aligns best with your values and priorities.
Well said. It's a good reminder that these financial decisions are often deeply personal and interconnected with our lives in profound ways. As you navigate your own homeownership journey, consider both the numbers and the emotions, the head and the heart.
Beautifully put. It's been a pleasure diving deep into this topic with you today.
Likewise. To our listeners, thank you for joining us on this deep dive. Remember, we're not financial advisors, so always consult with a qualified professional for personalized guidance. Until next time, keep exploring, keep learning, and keep diving deep.